The Rebel Capitalist Show.
I want to ask you just kind of a basic question that might not be so basic. Why are interest rates important? Why are free market interest rates important?
Well, I'm so glad you asked. I'm talking my book now. Our little journalistic lemonade stand is called Grant's Interest Rate Observer. You can imagine when there were no interest rates these past years, we have a heck of a thing for our business model. Need a magnifying glass to see the rate of interest. Interest rates are the Swiss Army knives of our finances. You use them to calibrate or measure credit risk. You can tell how creditworthy or not a borrower is by the rate of interest that it pays. Interest rates discount future cash flows. They are the price of time, as someone once said. They help us to set investment hurdle rates. You can think of them as traffic signals in a market economy. They say go fast, go slow. They indicate the level of liquidity available. If things are tight, rates are generally high. And if rates are peculiarly low, you can kind of conjecture that the reason might be that somebody has his or her thumb on the scales, and that someone would be our monetary masters at the Federal Reserve. So I have contended, George, that because our interest rates are not discovered in the marketplace these days, but rather imposed from on high, or if not imposed, heavily influenced from on high, that to that extent, we are living in a kind of financial dream world. We are living in a hall of mirrors because things are not what they seem. If interest rates are essentially nil, there is no discipline in the financial markets, or very little discipline. Companies can say, yeah, in year 2047, we'll be earning $6 a share. Oh, that's good. Yeah, very good. Now, a proper rate of interest would check that tendency, because people would discount that claim and say, I'm not going to bet on that, because for one thing, I can get 5% on a treasury bill. I'm not going to take that distant line of fantasy. So in this world of, you can also think of, I guess, as zero gravity or weightlessness. You can imagine some of our billionaires floating around in space when they take their rides into the ether. There's Jeff Bezos floating around. But without interest rates, we all kind of live in a zero gravity financial world. We're kind of floating around, buying NFTs and DraftKings and Bitcoin, all that stuff. Zero gravity, George. That's the concept.
It just pushes people further and further out the risk curve.
I say yes. I think it does. Well, then, that's an old observation. One of my biographical subjects named Walter Bagehot, who was a guy who lived in the middle of the 19th century, and he was the kind of the monetary muse of the gold standard era. He was credited or blamed for the doctrine that central banks in a time of crisis ought to lend freely, but he also said to lend at a high rate of interest and against good collateral.
Yeah.
Our central bankers today especially recall the idea of lending freely. The rest of it they kind of forget.
Yeah.
But it said, you're alluding to the national symbol of Britain. He said that John Bull can stand many things, but he can't stand 2%, meaning that a rate of interest as low as 2% would incite a lot of speculation and get a lot of people hurt, because they would start buying the bonds of these emerging markets, in South America and elsewhere. And there were a lot of cycles of emerging market boom and bust during Bagehot's time, and he linked unusually low rates of interest to that kind of financial behavior. And see it today. I mean, pension funds, everyone needing a certain rate of interest with which to satisfy actuarial demands. It's looking around for things to do. How do we do that when the 10-year Treasury is yielding less than 2%? Well, junk bonds yielding 2.25%, or emerging Russian debt. That seemed promising until about 2 weeks ago. So I don't think we've seen the last of the consequences of this featuring for yield. In fact, I'm quite sure we have not. It'll come out in the wash.
Is it fair to say that if interest rates are the price of money, and money or dollars, currency, is 1/2 of every single transaction, then if you're manipulating interest rates, you're effectively manipulating the price of everything that you can buy in the economy?
Yes, directly or indirectly. Certainly, you manipulate directly the price and valuation of financial assets. And insofar as financial assets feed into the other daily occupations in our economic world, they also manipulate that. I said the direct and consequential outcome of suppressed interest rates is, well, kind of think of it, George. When interest rates are manipulated, especially when they are suppressed and pressed down to kind of law level, there's a lot of wasted capital. Or people undertake projects for which there's no real demand, a fanciful, imagined one. The imagination can run rampant in this world that we decided a moment ago was kind of resembled zero gravity. And there's a lot of waste. A lot of it's fun. People have taken up speculation not just because they hope to have a sound and sensible early retirement, because it's fun. And lights dance, and you get a little splash of confetti on your Robinhood account. You're used to it. But there is amusement, and I guess that's an economic good. But there's also a lot of misdirected capital, a lot of white elephants, a lot of waste, and those have real world consequences.
How many of the businesses in Cathie Wood's portfolio do you think would exist today if we never got below 5% Fed funds?
I think fewer, to be sure. That even during gold standard times, there were cycles of great enthusiasm over technological developments. There were periodic railroad booms in the early and mid, especially in the mid 19th century. There were great excitement over all manner of canal boom in Britain and in this country as well. So, I think there's a tendency sometimes, and I certainly feel it because I have developed such an antipathy towards the Fed, how it operates, what it seems to stand for, how it's peopled, what those people seem to believe. I've developed this antipathy, but I check myself at times, I try to, by recalling how many of the blemishes that we see in our own financial lives seem to be congenital to the human condition, not just to a given monetary regime. I've often reflected that money is not humanity's best subject. Around large sums of money, people just go crazy. Which reminds me of the unintended humor of the idea of an efficient market, in which there is the pure and hygienic discounting of expected cash flows. And there is the perfect competition and the perfect dissemination of information amongst all players, all these preconditions. No, that's not the way the world operates. When you get around a potential big sum of money, it's like falling in love, right? You go crazy.
Yeah,
so
right.
Things and can't sleep at night. So I would say that the truth falls somewhere between the efficient markets hypothesis, the soft form, and my somewhat exaggerated hyperbolic riff on it. But Cathie Woods, I think there have been Cathie Woodses during pure gold standard during the interwar fake gold standard called the gold exchange standard. There were Cathy Woodses during the Bretton Woods twilight fake gold standard. And there is the real Cathy Woods during our PhD study.
Yeah, so we can't say that artificially low interest rates are the total cause of the speculation that we see in the market today, or the hysteria, but it definitely contributes, or it exacerbates.
It does it, and what it also does is elongate these booms, deepen the risk and the preconditions of a serious bust. And then what happens? Well, the Fed comes in, and the Fed cuts that short. So we pile debt on debt and boom on boom until boom.
Yeah.
Boom.